Resources Committee meeting. And the first item on the agenda is a proposed amendment to the HCV administrative plan. Jim?
Norman can cover this in detail, but as everyone knows, we're in shortfall. We've talked about it. In just their review of our policies, they noted that we do not have it's really a small item, that if we ever terminate a family due to insufficient funding, we don't have a policy on how to bring them back. And so this will establish that. HUD requires it. We told them we do it rather quickly. So we're asking that the committee approve this and send it to the full board on Tuesday, so that in our next conversation with HUD, as they identify additional funding for our vouchers, we can demonstrate rapid progress. It's really small. It's never happened. Part of the reason it's not in our policy, we never even thought about it. And we never thought about terminating anyone off a voucher that has one. So this is just an administrative ad. Norman, do you have any details you want to share on this?
Well, I think you covered the purpose of the proposed amendment for the committee, so I don't really have anything else. If they have questions, I'll be happy to try and answer.
Does the committee want to see what the amendment is? Is it in everybody's package? Just want to make sure everybody's had a chance to take a look at it and feels comfortable with what it was. If not, maybe we could get somebody to share their screen.
It is in the, should be.
Norman, can you just quickly summarize it?
It's a simple language where we did have the policy for reinstatement of our special purpose vouchers, the VASH, the non-elderly with disability vouchers or mainstream vouchers, those special purpose, but we didn't have the regular tenant base covered. So we just added the language that states after reinstatement of any special purpose vouchers, all other families will be reinstated in the order based on the date of termination.
Thank you, Norman. I do want to acknowledge that I believe that Commissioner Campbell's on the call with us as well. Commissioner Campbell, can you let us hear your voice if you're here? Okay, we're not hearing you. Be on mute. All right, I'm not sure if he's here yet, LaTanya, but please let us know if he's on the line, just to make sure we have accurate roll call. Okay, going back to Norman's presentation. Kay, you're raising your hand. Do you have a question? You're on mute, Kay.
Now can you hear me? Okay. Special purpose vouchers, does that cover elderly and disabled? Is that what comes under special purpose vouchers?
Yes and no. It's not all elderly and disabled, but many of these special purpose vouchers are designated for elderly or disabled. For instance, the mainstream, the non-elderly with disabilities. I mentioned VASH, but they're not always elderly or disabled, but some are, but not all.
But not all. And are there particular categories that fall under special purpose vouchers?
Yes, that would be the VASH, what's called non-elderly with disability, mainstream, and non-elderly with disability.
Okay, that helps. Thank you.
Oh, Bill, yes.
Thank you, Madam Chairman. Norman, on the amendment itself, let me just be clear about this. The language that's in the package amending section 17B3E as follows. Is all of that new language, all of it?
No, sir. Only the last sentence. Everything else was in there before.
So the last sentence just simply says, after reinstatement of any special purpose vouchers, all other families will be reinstated in order based on the date of termination.
Yes, sir.
Okay. The other policy, I understand from Jim's comments, the other policy, while it's been on our books for some time, has not been utilized or been necessary because we haven't terminated people from the program.
No, sir.
Okay, thank you.
With that, is there a motion? Okay, thank you, Bill. Is there a second?
Second.
Thank you. Any further discussion? Okay, and with that, please signal by saying aye if you recommend approval for the full board.
Aye.
Thank you. Okay, moving on to the next agenda item. I do want us to just be mindful of the time for this next item and try to move through it as quickly in light of the fact that we have such a meaty next committee meeting. So this is the approval of the Public Housing Authority annual plan. Jim, let me turn it back over to you.
Sure. So this specifically covers the public housing portion of our federally subsidized affordable housing. I think everybody knows we've gone through RAD. All of our apartments, the vast majority are now under project-based rental assistance. So these policies do not apply to those apartments. They apply mainly to our vouchers. It's an annual requirement. We've supervised this, gone through it many times. We've had public meetings. We've had public comments. As the write-up says, we've arranged for teleconference with the resident advisory boards for our vouchers. And it's a relatively straightforward plan. Jim Thilgen has been the architect, so I'd call on Jim if you have any detail you'd like to share of any specific highlights of the authority annual plan. Jim T, you with us? Yeah, I know he's up there. I just saw him a few minutes ago.
We can see him, but we can't hear him.
Jim, we can't hear you. Can you unmute?
I think he's on mute.
This is LaTanya. Can you hear me?
Yes.
Yes.
Jim's having trouble with his phone.
Can you just, are you up in your office? Can you just step across and add any comments for the board?
Okay,
Oh, no, we got you. We got you. We got you. Come back.
okay,
Yeah, there we go.
okay. What I was going to say is the plan, the annual updates to the plan now is mostly a progress report against any of the goals that we had established a year ago in our 5-year plan. And so mostly it's talking about, kind of what we've accomplished in terms of adding new landlords to the Section 8 program, what we've done in terms of outreach and things like that. It also provides for any, if we want to make any change in the plan, we would do it at this point. We also talk about what we've done in terms of the Faircloth Amendment, where we said we're going to add additional units as they became available. And we talked about the progress we're doing with Randy Rogers and the Red Oak townhomes. So mostly it's an update to goals we established a year ago.
Thank you, Jim. Are there, okay, go ahead. You're on mute.
How about that? Okay. I have just a few quick questions of clarification and then a request. So in the document, Jim, on page, oh gosh, let me find it. Page 5 of 9, goal 2, bullet point 1, 2, 3, 4, 2E. Increase the percentage of vouchers leased in non-impacted census tracts. What's the definition of that?
Jim Thilgen, I'm going to have to ask you to take that. I don't know off the top of my head. I know what I think it is, but I'm not certain. Can you field that one?
That's probably a question for Norman.
20%.
Say that again, Norman.
Poverty rate is less than 20%.
Okay, thank you. And then on page, the next page, on page 6 of 9 at the very top, objective 2H, it says maintain a CMAP score of 97 or higher. What's the definition of CMAP?
Section 8, management assessment program. Plan.
It's program.
It's program and, okay, and you're graded on that somehow?
Yeah, there's various factors that we're graded on, and some we grade ourselves, others HUD grades us based on the information we submit to them.
Okay. Okay.
I mean, I might say also that that's something we submit to the board usually a month or so after the end of our fiscal year. So that is submitted to the board each year, usually in November before we submit it to HUD.
Okay. Okay. And then I know we're pushed for time, so I'll just make this next statement a request. And I am particularly interested in the new homeless housing partnership with Metro government and how that's designed and will be run, since it's for vulnerable homeless individuals. And so I have a number of questions around that. I'm not going to ask them today, but I would at some point like to have the opportunity to just, Jim, engage, or Norman, maybe it's you, not sure who it is, engage in a dialogue so that I can have a good understanding of that, since it's not quite in MDHA's normal wheelhouse.
That sounds great, Kate. LaTanya, and this for all commissioners, should be setting up on my calendar one-on-ones for us, so we can just cover it when we meet. I think we've already got a window of time set for us to.
We do.
So we can discuss it then, and whatever you need for staff support, we'll get for you. Okay.
Thank you. That's all.
Thank you, Kay. Any other questions? All right. Is there a motion?
And maybe one final comment on this. For the meeting on Tuesday, or right after the board meeting on Tuesday, we're going to adjourn and have a public hearing if there's anyone who wants to make additional comments on the plan. And then the plan itself will be submitted to the board at the August meeting.
Oh, okay. So would it be open to the public?
Yes.
Yes. This is one of the requirements for the plan. We have to have a public meeting. We've already noticed it. So we'll finish our board meeting, and then the board chair will reconvene and open up for any public comments on the plan. And we've been working social media and making notifications. We typically have no one. Sometimes Steve or somebody will come in previous years, but it is a requirement in addition to the other public opportunities that have been presented, including comments on our website.
Okay, thank you.
Okay, so with that, do we have a motion to recommend approval of the Public Housing Authority annual plan, as well as the 2 guide form resolutions related to the certificate of compliance and the civil rights certification?
Motion to approve.
Sorry, who was that?
Bill Purcell.
Okay, thank you. And a second?
Second.
Okay, thank you. Those in favor, please signal by saying aye.
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 Those opposed? Okay, and the motion passes. With no additional business for Housing and Community Resources.
Hey, Emily?
Yes, Aoli?
Yeah, this is additional business, and in the same vein of Kate's question, and excuse me, in a similar vein. So I think when we get to kind of sort of human resources and stuff and things of that nature, I really want to try to understand is the goals that are laid out in this PHA in this plan in the HAP plan. Is this the same goals by which the executive leadership that sits on kind of sort of their annual, performance evaluation, is this the goals that are aligned with our human capital and performance plans as well? I don't know. I'm just asking that question.
Yes.
Got it. And so how it like, so I think again, it may be a topic for another question, but I'm trying to understand is if that is happening, it was not very clear to me that we are approving this plan with the view that this becomes the goals of our executive staffing committee, and this becomes the performance evaluation metrics that we as a board, review that staff on an annual basis. So, so like I said, I think it's something for the for HR committee when we get there, and it should get on the agenda. But it was not clear to me that these are the performance metrics for the executive staff.
If I may comment, Jim, beforehand, I think it's very important that we discern that this plan is very specific to what is termed public housing. So it's right. And that portfolio is quickly being converted and going away. And so I actually perceive this more as, pen to paper, getting something that HUD is requiring of us, while Aioli, I hear you, because it does include and reflect a lot of our larger objectives and goals. I don't know if this is the document for which we should be setting performance metrics, but I hear you. I hope that we can return to that conversation. Where are those living, and how are we seeing that connect in terms of evaluating staff?
As the chair of that committee, I would agree with you, Madam Chair. I would say, in fact, for the record, that the committee and the board evaluates the executive director.
That's right.
And the rest of the evaluations within the agency occur from that level down. And it's the whole broad range, as the chair indicates, of all the things that MDHA does across the entire footprint of the agency. And that evaluation process and the way in which that's conducted could be a portion of our evaluation of the executive director. One of the things I would like to do at the next meeting next week is briefly address a timeline. As you know, that process has not occurred formally within the board since 2017. And I agree, Commissioner, with you that it's that time under our contract with the executive director to lay out a process going forward. And so I'd like to start, you're perhaps reading my mind that it's time. And so we can have a brief or a long conversation if you'd like next week, but just simply to set a timeline for the committee to begin to do exactly what you suggested. And that is before the end of this year, enter into a more formal process of goal setting, priority setting for from a personnel standpoint, which leads to an evaluation process that's ongoing and allows for continuous improvement. So I agree with you.
Yep. Thank you.
Yes.
All right. And so with that, I think we can adjourn this meeting and start our next meeting of the Joint Finance and Development Committee. I believe we actually have all commissioners now on the call with us. So I want to reflect that. Paulette, can you unmute and just let us know if we can hear you okay?
Yes, I'm here.
Okay, wonderful. Good to see you. And I know that Commissioner Campbell was having issues with audio. I don't know if those are resolved yet. If so, can you unmute and let us know you're here?
I'm here. Can you all hear me?
We can hear you. I'm glad that worked out.
Yay. Okay.
All right. Well, so I think we're ready to go, and we can hop into the first agenda item, which is a pilot for, the pilot program annual analysis and pilot agreement for Hickory Ridge.
So tying this back to the previous conversation, if you recall, at the board retreat, I presented the objectives and goals for the agency, which led to a subset of those is the public housing plan. One of those is to increase the supply of affordable housing in Nashville and Davidson County, and that is what this program exists for. We have a payment in lieu of taxes program called Pilot that we collaborated with the city and passed into law under state law in 2015. And it allows us to do the underwriting work and the board to approve a payment in lieu of taxes for those properties that have received a low-income housing tax credit, federal tax credit that the Tennessee Housing Development Agency administers. The state of Tennessee is the only one in the country that taxes the value of that tax credit, which diminishes its ability to provide affordable housing because the additional taxes means you have to have higher rents, and the rents are capped under the LIHTC program. So the pilot restores the property tax that the property assessors is required by state law to put on the LIHTC deal, and allows these to underwrite and to provide more affordable housing. And it's been an extraordinarily successful program, probably one of the great unsung heroes of affordable housing in Nashville. For this specific one at Hickory Ridge, Joe will cover the details, but this is a program that has been extraordinarily successful for us for 5 years. The amount of tax forgiveness is capped on an annualized basis. We've never come close to hitting the cap, and it's one that's quite popular with council. On process, I think as you recall, because you've done a couple of these, should the board approve it, which we believe, we strongly recommend you do so, and we think you will, then it has to go to council, and council will approve the pilot in both budget and finance will review it, and then the council will approve it, and then it will go into law. So that, Joe, can you cover the details of the pilot for Hickory Ridge?
You're on mute, Joe. We can't hear. There.
All right, hang on. Let me get off of this. All right. Thank you. This morning, I'm pleased to present a Hickory Ridge. This is an application for a pilot. This is 60 new units that are being proposed to be developed. Actually, they are actually developed. They came to us late in the game, pretty much anticipating a property tax increase that was going to be taking place in here. And they have come to us requesting a pilot. We have reviewed their pilot application and have done a full analysis of this and are recommending that we enter into a pilot agreement with them. This is 2 and 3 bedroom units out in Hickory Hills Boulevard. And the project, like I said, is essentially complete at this point in time, and has actually gotten a partial reassessment already from the tax assessor. And so we do know that they're going to need the abatement on this with the new property tax increase. We have gone in and changed our property tax abatement that we've done historically. Metro Council gives us $2.5 million per year as an authority to do this. We had gone through this. We had already awarded about 4 other projects already to date: Hobson, Trinity, 808 Skyliner, 808 Skyline Ridge, and Skyliner. Those 4, we have gone in and recalculated what that abatement is based on the new tax assessment, the new tax assessment. I'm sorry, the new tax rate, and have recalculated this. And so, with the approval of this one, there will still be $500,000 of abatement, even with the 35% property tax increase that Metro Council passed with the budget last month. So we are recommending approval of this from the committee, and we'll be at the full board meeting with this following next month.
This is Paulette. I have a question. Projects that you've listed, 4 of which have already received tax abatement. In terms of market rate, are they, how do properties spread out in terms of what the rents will cost?
So Paulette, Commissioner Coleman, all of these pilots are specifically for low-income housing tax credits, the federal program that THDA administers. And in that program, the rents are pegged at 60% of AMI and below. So all these units are affordable. There are no market rate units in these developments, and they're all at 60% or below. So that's what the purpose of the pilot is.
Yes, I understand that perfectly. My question is, does that translate into rents?
I don't have that.
I know you can't give me a specific, but the range.
Joe, do you have that? I don't have it at hand, but we can get that.
I do not. For 2 and 3 bedrooms, I will be able to get it here for you in a minute as what we project those rents to be, but it's going to take me a minute to get that. One thing, it is essentially a Section 8 rents is what it is. It is established at the Section 8 rent levels. And so those are the caps for the rents for the 2 and 3 bedrooms. I wanted to clarify that that this project, like many of the projects that we have seen of late, are taking advantage of a new THDA ability to have a average income averaging, so that the average income of everybody in there is at 60% or below. And so if someone gets a little over income, they can stay where they are living and don't have to move out. With that, the next person they pick up is going to have to be less, so that the average income of everybody who lives in the development is at or below 60% median income. It's been very popular, and most everybody is adapting that process when they make application to THDA.
Joe,
the new program of THDA that they can now average, and it's over what period of time?
It would be they do annual reporting, and so I mean, it'd be the average income of every year. They are doing income updates on everybody that are residents in there. That's part of their annual reporting, and then we have annual monitoring that goes along with that as well. And so it's based on the average income of the residents.
Thank you,
Joe. Joe, can you hear me?
I can.
Joe, isn't that, but along with that change, isn't there a cap that the maximum income is 80%?
Yes, it is. You're absolutely correct. I'm sorry, I should have clarified that. So it gets up to the 80, but all are below 80, and they average 60. Thank you for that clarification, Kate. Thank you.
Sure. And then is this project in Madison?
Yes, generally out in that. Wait a minute, I want to say Hickory Hills. Yes, Hickory Ridge.
That's out of town.
Well, it's not in town, correct?
I mean, county.
But it's 579 Hickory Hills Boulevard. I believe that is up in the north side. I don't know if you exactly call it Madison, more north off of, I believe, off of Dickerson Road in there.
Okay, thank you.
Mm-hmm.
So for Commissioner Coleman, for the fair market rents for a 2-bedroom, the range is $800 to $960 a month, and for a 3-bedroom, $900 to $1,080 per month. And that range will, the determining factor will be how the developer chooses to structure his deal with THDA. So you can go to what's called 2050. You could have 20% of your units at 50% AMI below, and some of those have lower rent. But the cap generally is going to be $960 for a 2-bedroom, and $1,080 for a 3. That's from the HUD table for this for the metropolitan service area here.
Thank you.
Joe, quick question. Did you say this project is complete or is it under development?
It is. They are looking to begin occupancy this month. So I mean, it is like 70% punching at this point in time.
Got it. So the units that are already on the site, are they a part of the program? Because there appears to be a set of completed units and a set of projects under development.
This is another phase. So this is for the new phase of 60 units.
Got it. And so is the first phase part of the is the first phase part of any kind of pilot program? Is it?
Not with us, no.
All right. Is there a motion to recommend approval of the pilot for Hickory Ridge?
So moved.
Thank you, Aoli. And a second? Thank you, Kay. All in favor, please signal by saying aye.
Aye.
All right.
Aye.
Thank you. And those opposed? Okay, and the motion passes. So being mindful of time, we are about to move into our Vanguard presentation on our retirement package and performance for the agency. I'm going to ask that we listen to the presentation and that we actually limit the amount of questions and discussion that we're going to be able to have here to make sure that we can get through the agenda, but with the understanding that we can follow up with Mr. Harbison on any additional questions or information requests that we have. Jim, is that the best approach?
Yes, just with one caveat. We told Vanguard to call in at 9:30. So Vanguard, unless Pat Thicklin, have they called in already? Pat, are you on?
Yes, I'm on, Jim, and also Adam is on the line, should be on the line as well.
Oh, so Vanguard is on.
Yeah,
I
am,
I've
yeah.
contacted. My mistake. Then we can. Then Commissioner, that's fine. Let's proceed. I thought they weren't coming on till 9:30. That's fine.
Thank you, Adam, for joining us earlier than expected. And so with that, let me turn it over to you all.
All right. Thank you so much. Can everyone hear me well?
Yes, you sound good.
All right. Wonderful. Thank you. I'm calling on my cell phone and using the wireless headset, so I want to make sure it's working well. Good morning, everyone. Thanks for allowing me to join your meeting. I did come in a little early, so sorry I heard any private information, but again, thanks for allowing me a spot in your meeting today. I know that my time is fairly limited, so I really want to streamline the conversation and focus on some points that Jim had called out to me as most pressing or top of mind to the committee. I'll try to get through my sections rather quickly and allow for a little bit of time at the end for any questions, or as she mentioned, we can always do a follow-up meeting as well if need be. I'm happy to join. So to start off this meeting, I gave you a pretty robust book. We're not going to go through the entire thing given the limited time slot. So what I'd like to do is start out with the investment portion, which resides on, let's say, page 40. So I believe everyone has a copy of the presentation. So we could just get to page 40 and I'll kick it off. So what we have here is a snapshot of the plan's investment lineup. What we're doing here is, and I believe you guys saw this last year in my meeting, but what we're doing is we're segmenting the investment choices into 3 separate tiers. So on the far left side, top of the page, tier 1, single fund solution, this is going to be the default investment. So if folks do not choose an investment, they would be put into the target retirement funds. So it only shows Vanguard Target Retirement Fund. Think of it as the entire age grouping suite of target retirement funds to fill that block. Very common with most retirement plans these days that they have that default option tier 1 selection as a target retirement age-based portfolio mix. Tier 2 down below that is going to be our building blocks. So if we were to pop the hood of the target retirement fund, we're going to call this a fund of funds. So the building blocks within that target retirement fund are these 4 cubes. So we have the Vanguard US Stock Market Index, Vanguard US Bond Market Index, and then their international counterparts. The goal of this, maybe I should have prefaced with this, is not to fill every box on this sheet. That's not the target. That's going to create an extremely complicated lineup that becomes overwhelming to the investors. We want to make this streamlined and simplified, but this is meant to really call out any potential gaps that we may have that we can't find coverage through other investments in. So when we look at this tier 2 building block, I don't want an abundance of concern to be drawn around the US stock box being empty. because if we were to pivot over to tier 3 supplemental choices, we can make up that US stock box using items like the Vanguard 500 index and the extended market index, which gives you your large cap growth and value exposure, as well as mid and small cap growth and value exposure. So again, not extremely pertinent that that box is filled, given that there are supplemental choices for the do-it-yourself investor. Non-US stocks, we don't have the total portfolio, so the Vanguard total US international, total international stock index fund there. But if we look over to the right of that under international and supplemental choices, we have the international growth. So there is an international stock exposure outside of just the target date funds. And then the only gap I would say here, which is I see very commonly in retirement plans, is the non-US bond fund, so international bonds. There is no independent exposure to that sector. However, that is one of the building blocks of the target date funds. So folks that are investing in those target date funds are getting that exposure. So again, I wouldn't draw extreme concerns to filling these blocks, given the exposure is available to folks outside of these individual blocks through the target retirement funds. And then lastly, on this page, in the bottom right corner, we show the other section. This is where we incorporate the balanced funds, so the Vanguard Balanced Index Fund and the Dodge and Cox Balance Fund. So these are fairly similar in the way that they're a stock and bond portfolio mix, thus being categorized together. However, the strategy that goes into the management is very different in that the Vanguard fund is strictly indexed, so it's just tracking the markets, whereas the Dodge and Cox is an actively managed approach, whereas their fund managers are trying to beat the market. And then if we can kind of pivot over to the next two pages here, pages 41 and 42, we can take a look at what these active funds are doing. The index funds in the lineup, so the target date funds and any individual index options are really, they're doing what they're supposed to do. And we'll see that as we look into performance. They're tracking their benchmark. They're not outperforming their benchmark, but their goal is to kind of walk lockstep with that benchmark, not to beat it, but to provide equal returns less the cost of the investment.
May I ask for a pause for a moment just to make sure everyone is tracking in the booklet in the right location? In my booklet, page 39 has a PowerPoint slide that says investment lineup summary. And then the page I think Adam is referencing called 40 actually has a number 1 at the bottom right-hand corner. And it follows that.
Sorry about that. Good call. This section individually numbers as well. So in the PowerPoint section, we're right now on 41. Bottom right corner, your page should read 7.
Okay. And so
thank you for the clarification.
Make sure the commissioners are all tracking on the right page. So that's all. Thank you.
No, thank you.
Have the PowerPoint.
Did you say you don't have the PowerPoint?
I don't believe so. We're just
we've got a booklet. That's all.
Oh, I'm sorry. It's a PDF. I apologize. Oh, I probably just set off fire alarms. No. It's a PDF file. I apologize. Yes, the booklet, the presentation of the booklet. We're in page 41, bottom right corner. It'll actually read 7.
Okay.
So now, if we're all tracking on the right page, it reads relative active fund performance, and it has a 4-box style grid. Hopefully that's where everyone is. So this is showing the performance of the active funds versus their benchmark, so what they're tracking and trying to beat, and their peer group, so all other active funds that fall into that same category. And this charts out how your funds are doing against those two benchmarks over the 1, 5, and 10-year period. Now, I never really want to draw too much concern to the 1 year. Active funds, 80% of the time, underperform their benchmark. That's just a fact in the market performance. There are times where they outperform their benchmark, but just seeing it underperform its benchmark or peer group in a 1 year term, I don't think should draw any concerns, because that's really the game they're playing. When we start looking at 5 year, 10 years, then we're looking at trends. We're looking at a continuous underperformance of what they're trying to outperform. So when we look at this grid, we would love to see everything be in that red box, right? That's outperforming the peer group, outperforming the benchmark. Everything is stellar. We do have one fund that resides in that portion of the grid in that quadrant over the 1, 5, and 10 year. That's the Vanguard International Growth. Where I would say we want to look at any potential concerns is that below box. I know it only exists in the 1 year performance, but let's take a look at that. Jim had called these funds out, and I think we talked about it last year as well, the Dodge and Cox funds. So if we can flip over to the next page, it's a continuation of this chart. So page 8 in the bottom right corner, 42 of the PDF.
Adam, sorry, I just want to interrupt for a second. In the printed version that we were given, we're actually missing that 4-box metric on everything except the Vanguard International Growth Fund. So we're not actually able to see how the funds are performing. I think that it was just an issue with printing. But if you could recirculate that after the meeting, that would be very helpful. Or you could potentially share your screen now.
I wish I could. Unfortunately, due to security, I wasn't able to go in through the WebEx. I had to just call in by a conference call. So I apologize, but I will recirculate this and make sure that you guys at least have a soft copy since the print didn't come out well. But ultimately, what we're looking at is just a 4-box grid, and it shows where the funds are performing above their peer group, above their benchmark, below their peer group, below their benchmark, or either or. So maybe it's above its peer group, but below benchmark, or vice versa. The only items that falls below benchmark, below peer group, so in what I would say, and I'm using air quotes, you can't see the watch zone, would be the Dodge and Cox Stock Fund and Dodge and Cox Balanced Fund. And again, we discussed both of these last year, and I know Jim wanted to discuss it again today. Just if we're seeing trends with this, which again, right now it's only falling into that bottom quadrant on the 1 year, so not the 5 or 10 year. So I wouldn't say it's a let's remove it today type of concern, but maybe something to watch or put on a list if you guys are following an investment policy statement, which I know I provided a sample of following my last meeting. So let's actually jump into the fund. So if we can go over to the next page, page 43 of the presentation, we will see a snapshot of the beginning portion of the lineup. It starts out with the Vanguard funds. As I mentioned, the index funds, so calling out on this page, the Vanguard 500 index, the extended market index, and the growth index, they're really doing what they're supposed to do. So if we look at that, even if we look at any column here, so let's just say the 3-month, that's the most recent. If we look at the bold black number, 3.56% on the 500 index, compare that to the number right below it, which is the S&P 500, 3.59. It's tracking its index perfectly. The only difference is going to be there's an expense, a cost in investing in the 500 index fund versus the S&P, which has no cost. It's just a benchmark. When we look at the active funds on this page, so let's say Explorer Fund, Growth and Income, and International Growth, they're all doing really well. So tracking their benchmark, outperforming their peer group in 2 out of 3 circumstances. So I'd say that these funds, again, are doing what they're supposed to do. There's going to be some variation between the actual performance of this and its benchmark or its peer group, just given the nature of the beast. These guys are trying to beat their peer group, trying to beat the index. So over on the next page, page 44 of the presentation, it's going to be the target date funds and the balanced index fund. Again, all of these are really tracking fairly tightly to their benchmark, given the fact that they are index-driven products. Next page, page 45, down at the bottom, this is where we can start looking at those 2 Dodge and Cox funds. a little more closely. So on this page, we have the Dodge & Cox Balance Fund. The Dodge & Cox Balance Fund, I do want to call out that I don't believe this benchmark is a fair benchmark that's used on this fund. So they benchmark it against the S&P 500, right? This is a balanced fund. It's about 70% stock and about 30% fixed income and short-term reserves. So the fact that this fund is tracking a sheerly stock index is not really a good representation. Why they're using that as their benchmark, I'm not sure, but I wouldn't say that it's underperforming it this vastly. So if we just look at the 3-month number, we're looking at a 6% variance there in loss versus gain. I don't think that is accurate given the fact that the benchmark is not a true representation of what this fund is. I think, however, we could look at it as a mixed target growth type fund because that's more of a balance of the peer group, and it is vastly underperforming its peer group at almost every clip, minus the 5 and 10. So anything from 3 months to 3 years, it's vastly underperforming. And then if we flip over to the next page, to page 46 of the presentation, we have the Dodge & Cox Stock Fund, the last one on the list here. I think this is a better representation. It does use the same benchmark, the S&P, but it is surely a stock fund. So I think that's a better representation. And we can see that this is, again, it's underperforming its benchmark pretty drastically, and then also underperforming its peer group at many of the points here from 3 months out to 3 years. So again, I wouldn't say that this is a fund that we need to tomorrow remove and replace in the lineup, but something that we certainly should keep an eye on and consider as a watch list item, maybe start looking at some potential alternatives. And I can always send out a list. I know, Jim, you had questions about this. I can send out a list of options that are available on the Vanguard platform. You can siphon through it and see what may be a good fit. That's really where I have to stop short of giving recommendations. I can't say this fund is better than that fund, but I can give you some options to choose from. If we get to the point in the future where we want to make a move on this, there are a few options. The fund can be closed to new investments and grandfather to any current investments, or we could completely close it down and map all the existing assets over to a similar fund that was replacing it. So again, if we ever get to that point, we have some options with this fund. So that really concludes the investment lineup summary. So the performance of the funds. I think, if we look at where the market was 3 months ago to the end of Q1 versus where the market is today, or at the end of this marking period, which was 6:30, we've seen some great recovery, hoping that folks maintain their goals and strategy in investing and stayed the course, as Vanguard would always recommend, and would have seen a lot of that come back that we initially saw go away when we entered this whole pandemic situation. I took a look at the numbers of the plan, and the plan total balance was at about 39,500,000 at the end of March, and up to 43 million at the end of this marking period, Q2. So again, quite a recovery in the market, and you can see that in the performance of the funds. So with that, and again, I'll try to save some time. I just, in the interest, I'd like to cover a few points on the state of the plan, just of how the plan's doing against its benchmarks. So if we could get to in the presentation, we're on page 29. And so this is what we call the state of the plan. We benchmark this Metropolitan Development and Housing Agency plan against Vanguard plans in general, and then plans of the same size, so same participant count, thereabouts, and same plan assets.
Can you give us a sec to get to 29? I'm not there yet.
Oh, yeah, sorry.
Adam, do you want us on the MDHA highlights page or the state of the plan with the bar
The
charts?
highlights page. Yep, the highlights page. Perfect.
Stay there.
And we don't have to go too deep into this because, again, in the interest of time, I do want to leave an opportunity for folks if they have any quick questions. Highlights at the top of the page, since you mentioned that, I just want to call out 2 items that have gone into law recently, and I'm sure you guys have been all over this in meetings, but the Secure Act was signed into law 12/20/2019. The Secure Act made a change to the RMD age, extending it up to 72 for those that reach the age 70.5 in this year. There's a change to the inherited IRAs. So previously you would base it off of life expectancy. Now it's depletion within 10 years. This may come into effect for you guys, but eligibility to part-time employees. Previously, you didn't have to extend eligibility to part-time employees. Now there is a requirement if they're working 500 hours over the past 3 years. So really opens up the opportunity for retirement benefits to those that aren't working a 40-hour work week. And then the CARES Act. This has been everything I've worked on over the past several months. It's the extremely important piece of legislation that went into effect on 3/27. I know that it didn't have the greatest impact on the MDHA plan, given the fact that the MDHA plan does not allow for the hardship withdrawals, so nothing to mirror there for CRD withdrawals, and then loan repayment suspensions doesn't exist because the plan doesn't offer loans. So really the only effect to your plan was the temporary waiver of RMDs. So folks that were already in that status could waive them through this calendar year. So jumping down, and we won't go through this whole presentation, I'll just stick to the summary statistics section at the bottom of the page, but we have graphs on each one of these data elements if you scroll through on your own. But just what I would like to look at this average balance. So the plan balance is a little bit lower than what we're seeing on an average as Vanguard, which isn't truly a great benchmark because we're looking at plans that are in our mega and jumbo market and then plans that are 20 million in size with 100 participants. So the Vanguard benchmark isn't the greatest for everything, but it just kind of lets you know what people are doing within our platform. Same size client, again, average balance is much below that, but there are obviously factors that go into play. Salary, income, total benefits packages go into play when we look at that. Equity allocation, this is of the population of investors within the plan, who's investing in stocks versus bonds. So equity allocation, it's about 59% in stocks within the plan versus same size client, about 68%. So I would say just in nature, this lets me know that your population seems to be a bit more conservative in nature when it comes to their investment philosophy. Nothing wrong with that, just calling out the numbers here. Equity contribution, we see that come in at a much higher number. The reason I would say that the contribution, so that's new money coming into the plan versus allocation is existing money, is the usage of target date funds and the extended popularity of target date funds for new folks coming in. So they're allocating to those funds more commonly, thus increasing the equity allocation of new money coming in versus what's already in there, folks that are maybe doing it on their own. And I did notice there are a few folks that are 100% in money market stable value type products. Next line item, professionally managed allocations. So what we're really talking about here is your account being managed, but we also consider target date funds and balance funds as professionally managed because it's kind of that set it and forget it, one-stop shop type portfolio. So of the portfolio, 48% of the plan, 48% are utilizing that type of structure. And then internet access, that's just how folks communicate with Vanguard. nothing alarming there. It's a point of preference. Some people like to call, some people like to go online. We see this number consistently increasing over the years, given the fact that everyone has a computer they walk around with in their pocket. But it looks like it is a little bit lower usage for the plan, for the MDHA plan versus what other plans are doing within Vanguard and maybe even of the same size. So that's all I have prepared for these items. Jim, you mentioned that you wanted to do a quick snapshot of the fees that the plan is paying. How are we doing on time with my section? I'm okay spending 2 minutes on fees if everyone else is.
Yeah, this is Saul, counsel to the plan. I think going over fees is really important for the fiduciary. So please do that.
Perfect, will do. So where we want to navigate to, and I'll give everyone a few seconds, page 50 of the presentation. And then if everyone is there, what this does is it gives us a snapshot of.
Sorry, Adam, can you wait 1 second?
Yep,
just to make sure that we're all getting there. So actually, if you can navigate to page 48, it's fee report, and it's one of the bigger blocked pages. And then we're going to jump forward, just flipping 1 page over. So it's actually listed as page 2, and it's the summary fee report. Looks like this. Matt, thank you. That is helpful. So Adam, Matt is sharing his screen so that we can see it. Okay, so
Awesome.
we're just moving forward 1 more page to the summary fee report.
There you go. Thank you. All right. So this report gives us a snapshot of the all-in fees being paid to both the investments as well as Vanguard for our record-keeping services. So let's just start with the top right corner, bold red print, 0.267%. That is the all-inclusive fee that the plan pays to Vanguard for the products as well as the record-keeping services. So all we're doing is we're saying 115,676 to the left of that, divided by the plan assets, 43 million. If we jump down to the middle of the page, we will see 2 additional red figures. The 0.16, this is asset-based fees net of record keeping. So this is how much participants are paying for the investment. So this is the expense ratio, which is just wrapped up into the price of the fund. So it's not an out-of-pocket cost, but it is a cost that investors pay to invest in mutual funds. So that's the 0.16%. What Vanguard is collecting in the sense of record keeping, so for everything we provide for the plan, that's going to be the 0.11%, the 11 basis points. Any quick questions on that, and then we can kind of dive into how this is calculated?
Adam, I think it's important if you have any data on peers or your competitors and how you compare to them. I think that's an important thing for the committee to understand if you have that.
Yeah, so I do, and I can follow up with this as well as an additional document, but we have partnered with a group called Fiduciary Benchmarks. What they do is they collect data from plan sponsors across the universe, and then they aggregate this data and run benchmark tests against how much one plan is paying versus their peer group. So same size plan, same participant count range, and then stack up the cost against one another to see where your plan falls. So the MDHA plan actually at 11 basis points falls below the 25th percentile plans overall in the universe when we map it up against plans of the same size, participant count, and assets. The 25th percentile is 12.8, or it's 0.128% versus 0.11%. So again, you're below the 25th percentile. The 75th percentile for this size of plan falls in about 0.185%.
Hey, Adam, is that broken out by record keep? Do you have a record keeping specific metric or not?
I don't know. This group partners with many record keepers, so hundreds of record keepers, and collects data and then just compiles it all. So it doesn't break it out versus record keeper. It's just on average, given this plan across the universe of record keepers and plans, this is.
No, sorry, I meant record keeping versus investment fees. So you have an all-in for both the cost of the investment plus the record keeping costs.
Let me see if I can get anything. Fiduciary Benchmarks may be able to give us a more comprehensive report that includes the investments. Let me check on that for you.
It's been a lot of. Go ahead. Sorry.
This is Bill Purcell.
Yeah, no worries.
Could you or our plan representative for the members and the public, could you translate what he just said concerning fees and the relative position of the fees in this plan versus fees in other plans?
What Adam appears to be saying is very, very good news in that your total fees, which includes both record keeping and the cost for investments, is basically it's lower than, at the very most, it's lower than 75% of all the other plans out there. So the combined fees, which are usually two broad categories, one is the actual record keeping and two is the cost of the investments. The performance appears to be very strong, which is a very important point for the plan and an important point for the fiduciaries. There has lately been a lot of litigation about excessive record keeping fees in particular, that basically says that plans are paying too much in record keeping, which is why I was interested in the record keeping portion only. So is that understandable, Chair, Mr. Chair?
It is. It absolutely is, and the answer on record keeping is to be determined.
Correct. Adam's going to see what he can do.
Actually, this is Adam. If I could just step in, the numbers I was just comparing to the below the 25th percentile for the plan, that is strictly record keeping. So we're not including the investment fees. That is strictly record keeping. So when we look at what you're paying Vanguard to maintain the plan outside of the investments, you're below the 25th percentile of what all other plans are paying on average.
Perfect. Okay. Thanks, Adam, for clarification.
Yeah, no problem. And then kind of follow up on your previous question. So segmenting out those costs on average, we're going to see that on the next page. If we could flip over to page 51. I kind of want to break down these fees and how they're being collected and being paid. So on page 51 at the top of the page, this is all of the Vanguard funds. In the third column, expense ratio, that's the cost of each one of these funds, the operational cost that the investors are paying. To the right of that, Morningstar average. In the peer group of those same funds, that's the average expense ratio in the industry. So if you look at, say, the Vanguard Growth and Income Fund, its expense ratio is 0.33% versus the average of the same type of fund in the industry is 0.92%. That kind of gives you a snapshot of what the expenses of the investments outside of record keeping compared to the rest of the industry look like. So just on a whole, when we look at the Vanguard lineup, its average is 0.25%, so 25 basis points, versus 0.77% on the industry average. All right, so within the same section, this is where it gets a little tricky. Try to keep up. I will repeat if need be or translate. You will see in the gold section here, $42,585. That $42,585 plus in the next gold section, $1,417 Those two amounts are record-keeping credits that the funds provide to the plan that we then use to offset our administrative costs. So basically, we take this $44,000 and apply that toward what we would be charging for your record keeping, reduce it by that amount, and that gives us the amount that we actually need to collect from MDHA as the plan sponsor, which is $7 a head, $3,185. So those credits that I called out a moment ago, $42,585 and $14,17, coming from the Vanguard and non-Vanguard funds, offset your all-in record-keeping fee so much that you only need to pay out of pocket $3,185 or $7 per participant. Does that make sense? I want to stop there.
That does make sense. And then, so is that being reflected in that is why we're sitting so low in terms of our expenses on the summary fee sheet?
No, it's actually not. So we're not looking at what you're paying out of pocket and then comparing that. We're looking at that all-in cost. So back on the first page, that 0.11%, $47,187, the record-keeping fee, that is what we're benchmarking. And then you're lucky enough to collect 44,000 of that through record-keeping credits, thus only having to pay out of pocket $3,000.
Thank you.
May I follow up? This is Bill Purcell. When you say we are lucky enough, how are we lucky, and where does that come from?
Well, so there's different structures to your fee structure or your payment structure, and I'll kind of try to break them down. What your plan is currently is what we would call a hybrid. We collect part of the compensation from those record-keeping credits, so that 44,000 some odd bucks, and then we collect some through direct compensation coming from MDHA as the plan sponsor, the $3,100. Another way that Vanguard could be paid is, instead of receiving those record-keeping credits, changing the fund share classes to the lowest cost share class, so investors pay less for their funds. In return, there is no record-keeping credit. Therefore, that same amount of compensation needs to be collected. So the $47,000, where are we going to get it from? If we're not getting the record-keeping credit, we still need to collect that same amount, then we need to get the money from either the participants or the plan sponsor as direct compensation. So that $7 per head would jump up to $200 per head, just using erroneous figures.
All right, Adam, thank you. I'm not really asking to change anything. I'm asking what you mean by
I know.
You are lucky enough. Where is our luck?
There.
Where is the money coming from under the current system? Who's paying?
Yes, it's coming from under the current system, given the fact that you receive so much in record-keeping credits that the out-of-pocket cost is so nominal. I guess that's what I meant by lucky, to say that you're almost covering everything just given those record-keeping credits.
Okay.
It's coming from the cost of the investment. Isn't that right, Adam?
Correct. Yes.
So the alternative is you could lower the fees for the investments and have the plan sponsor, MDHA, pay for more record keeping. It's not
right. So at the end of the day, at the end of the day, we need to collect $47,000 some odd dollars, right, for our services. Where that comes from, we're agnostic to. So it can come from record-keeping credits.
Just where is it coming from? That's all I want to know.
Yeah, it's coming from the plan assets or the plan expense, actually. It's not unusual that plans do pay for record keeping out of the plan assets. That's not unusual, and so we have a little bit of a hybrid in that up to a certain amount, record keeping is paid by the plan via the cost of the investments, plus MDHA does contribute, I guess in our case, about $3,000 a year as well.
And you're comfortable, Saul, as our advisor?
Yes.
Thank you. That's all I have.
That's absolutely correct. Thanks for the explanation. So, barring any additional questions, that concludes my prepared commentary. But again, I want to be sensitive to your time, but I'm certainly open to questions, or if we need any follow-up items, I'm happy to follow up as well.
I would just like to request so based upon our presentation last year, one of the concerns was lack of participation by employees in their retirement funds. And so if you're on the phone and able, I would love to hear an update from you all on what we've been doing to improve our employees in terms of investing in their retirement.
What we have done is that for new employees coming into the agency, we spend more time working with them, understanding the investment plan and the goal of the retirement program. So we provide more discussion with them and also provide them opportunities to learn more about investments when they first start with the agency. And then throughout their employment with us, we talk with them about growing their retirement. So in other words, we provide more education to them up front about the retirement program. For existing employees, we encourage them also to provide training and handout materials so they understand how the retirement program works and what the goals for their retirement would be as their lifespan here at MDHA grows.
Thank you, Pat. And just to confirm, we set up payroll so that we are defaulting employees into their targeted retirement account. Is that correct?
No. When they come in, we explain to them how the programs work, and we explain the targeted funds and how they grow, and we show them examples of what they can get in retirement if they stay with the agency 5, 10, 15, 20 years, and we show them historically how the targeted funds have grown to increase their value through the years. And they understand it's easier for them to go into the target funds because it's like they can put their money there and they don't have to worry about switching investments, but they can watch the funds grow through their time working with us.
Okay, and we also have a very notable matching policy at MDHA, and I wonder if all new commissioners are aware of that. Can you please summarize that?
The what policy again? I didn't quite hear.
Our matching. The match that MDHA provides for retirement. Can you please summarize that for new commissioners?
MDHA provides 13% of the employee's salary into the fund. This is not a matching fund. It does not come out the employee's payroll. MDHA puts that money into the program under their name. They do have to spend with us 5 years with us to vest completely into the program, but starting with the first year up to 5 years, they get a percentage of that money till they reach 5 years, and after 5 years, it totally become their money into the plan itself under Vanguard.
And Pat, they're allowed to put more money in if they choose, correct?
They can put money in, but that money would have to be in a separate account. The retirement plan we have for employees, only MDHA can put money into that account. We do encourage them if they want to invest more or catch up into their savings for retirement, we give them an opportunity for either do it pre-tax or after tax.
This is
Paulette, I believe you were trying to ask a question and you're on mute.
sorry. Let me understand correctly. MDHA contributes 13% of an employee's salary into a retirement fund?
That is correct. Yes.
And then you were saying something that they can contribute additional amounts to separate fund, either pre or post-tax.
Yes. Now the pre-tax has to go to a different fund. We have a program through Nationwide, the 457 annuity, or they can do after-tax and create a volunteer account with Vanguard that they can invest in. It's similar to a Roth type account.
And this
You
is
have-
Adam. Just to be clear, the account for that employer contribution and or the after-tax contribution, it's the same account. It's different sources or buckets within that account. So they wouldn't have two separate account numbers, two separate logons or anything like that. It would all reside under one plan balance. But if you, again, pop the hood and look underneath, you would see different sources.
I have another question. It looks as if 455 of the employees participate. Is that correct?
That would include current employees and employees who have left the agency that still have money in their account, yes.
Oh, so do you know how many of current employees participate?
All employees of MDHA current employees participate, and that would be a little over 340 employees or more.
And Pat, when you say participate, you mean by way of the employer contribution that MDHA is making each year?
That's correct.
Okay.
Adam?
Yes.
Can you hear me?
Yep.
Yes. When you say buckets, tell me about the buckets.
Yeah, so within a 401k participant account, there are different, what we call sources of money. So it could be like a pre-tax contribution, a Roth contribution, a rollover contribution, employer match, profit sharing. There could be many different sources within that. I use the terminology buckets synonymously to sources. It's just when the money comes in, we segregate everything within their account to determine where it came from. The main purpose of that is, to Pat's point, around vesting. So that employer contribution that's made on 13% of the employee's salary follows a different vesting schedule than the employee's contribution. So if I make a contribution to the MDHA plan as an employee, my money is 100% vested, means if I leave, I'm entitled to 100%, versus the MDHA contribution, it vests over a 5-year period. So if you leave on year 1, 2, 3, 4, or 5, you're going to receive either 20, 40, 60, 80, or after 5, 100% of the contribution. So that's really, it's just a record keeping tool for us and plan sponsors.
Okay. And then the second question, I assume for the employee investments, there's a category of, there's a list of funds that invest into mutual funds. Tell me how that works.
Yeah, so it's the same funds that we have been reviewing through this presentation. So it's the exact same lineup. That's just how they want to invest that money. And again, part of the reason for having sources. So if you said, okay, I want that employer money to 100% be contributed to a money market, and then my money I want to go in a target date fund, we would be able to do that with the new money coming in. We say bucket A goes to target date fund, bucket B goes to the money market.
Okay. And then my last question is on, I guess, what I would call investor education. And who provides that? Who educates the employees and helps them understand each of these options, asset classes, or how that works?
Yeah, so it sounds like Pat is providing, or her and her team are providing some upfront education to new hires. Vanguard certainly has some education strategies as well that we can help implement. I added a section in the presentation book around education solutions.
Right.
So no, you're okay. I just want to call that out so you could kind of take a look. But what we can do for what we're doing for current participants is we have an intelligent machine running in the background all the time that's collecting everything we know about participants. So their activity, their compensation, how much they're contributing, what their risk tolerance may be. And then we are making recommendations automatically through push notifications that say, hey, we noticed that you don't have a beneficiary name. take this quick action step and name your beneficiary. Once you name your beneficiary, the next time you log on, you get another message that said, great job last time, you named your beneficiary. So behavioral finance shows that once someone receives recognition for doing something well, it encourages them to do it again. So we continuously push out these nudges and recommendations and they're targeted to that specific participant. But this is happening automatically all the time. We're constantly collecting data, and as we see a recommendation surface for a participant, we're pushing out that notification, no more than once a month, but we're pushing out a notification. And then also when they're logging on, they're seeing one of those tiles on the main screen, giving them a status update, and another tile giving them a next step recommendation. So this is automatically happening on top of any education tools that we have out there as well. So we have investor questionnaires where they can go through and assess their risk tolerance and get recommendations and those types of tools through our website as well. But again, this is just something that we automatically are performing for each and every participant.
But am I right that the plan sponsor is the one that once the employee makes their decision, then the plan sponsor just automatically sets it up and they, invest their monies. So I don't understand the connection between the employee going in and doing some things. I'm confused on that.
Well, the employee directs their investments. So let's say they received the contribution, the 13% of their salary from MDHA. They can change that investment within their account. So they would be able to go in and receive education from Vanguard, and maybe they didn't know what they wanted to do and they parked it in a money market. Okay. Now they're becoming more educated through some of our tools and say, I want to make a change and exchange that into a target date fund. Okay. They can do all that through Vanguard.
Okay, yeah, well, I got it.
And just one last note on education solutions. You mentioned providing education to employees, both new and current. Vanguard can do so through on-site education meetings, which doesn't exist in this current environment, but hopefully in the future we can do that. We'll all mask up and come down. Or we can do the same type of presentations through webinars, which I think in this environment is really a great way to touch base with the employees and get good participation because everyone's already sitting in front of their computer at home. So we can run educational webinars that are customized to the plan, given the topics that you want. I put some topics in that education section of the presentation as well.
I think that'd be a great idea.
And then I have one last bid here. It's we have complimentary webinars that we host quarterly on pre-selected topics. We are running our next webinar August 7th and August 10th, and I included a flyer in the presentation on page 58 welcoming you, and it also has the link if you have the soft copy, but I'll send the soft copy out following our meeting as well.
Thank you.
You got it. I think I took way too much time today. I'm sorry.
Thank you, Adam. We appreciate your time. Are there burning questions that cannot be answered by Jim after the meeting at this point?
One quick question, Bill Purcell, and this is for Saul. During the presentation, there was a mention of companies outside of Vanguard for funds contributed outside of MDHA. I heard the mention specifically of Nationwide. I'd just like some clarification. Are all of the accounts that we offer and have responsibility for, both those that we contribute to and that our employees contribute to on our recommendation, were they contained within the presentation, or are there other funds outside of those which we have not heard about today, and specifically those mentioned by our staff?
The Nationwide Fund is a voluntary fund, and it is not included in this presentation. So it is outside of the retirement program, and an employee can voluntarily go to Nationwide and invest funds with Nationwide. They will have to open up the account themselves in their names and we do payroll deduction directly on their behalf to Nationwide. It is not part of the Pacific Retirement Program.
Right. And are there other accounts other than that one that we offer to our employees with the possibility of direct deposit or direct withdrawal from their salary?
Not through us for retirement. They can do something independent outside of MDHA
Sure.
that we can send
Sure.
money to, but that is the only program that we offer to employees inside for retirement.
Okay. And is that one that we review as a board as well? And is that one that you and MDHA review and make recommendations concerning specifically in the context of the kind of data that we reviewed today, that in terms of returns, options, and other choices? And is there a periodic review by the board of that option?
Since it's a voluntary account, we do not oversee it, so we do not ask the board to look at it.
Okay, thank you. I understand our policy. Saul, I would ask you to at least review that issue and give us advice as to whether we have an obligation in that regard. Metro has in the past, the larger government actually had that issue arise and has found there was some responsibility in making offers of plans to employees in that way. That there were fiduciary obligations upon the city. So I just ask you to take a look at it, set it aside. It's not part of the Vanguard presentation, but we should have some sense of our responsibility in that, if any. And I'd like you to advise us.
I'll get with Will Chopin on that, and we will do so.
Thank you.
Thank you. So Jim, let me ask at this point, as a matter of business, do we want to post redevelopment districts and adjourn this meeting because we have the Human Resources Committee agenda to get through? Is Jim there?
Yeah, sorry. The redevelopment districts will take more than 30 minutes. So I'd recommend we move to human resources.
Okay, thank you. So if there's no additional business, let's adjourn the Joint Finance and Development Committee meeting. Okay, hearing none, the meeting's adjourned.
With that said, I just, again, want to thank everyone for your time today and really appreciate the great questions. If they generate, as you digest this information, please feel free to have Pat shoot me any questions. I'm happy to send any additional information your way.
Thank you, Adam. We really appreciated your time today and the materials.
All righty, folks. We'll take care then. Bye-bye.
Bye. Jim, would you like to identify, or Saul, the chair of the HR committee and the members?
Yeah, I'll apologize, Aoli. I was on vacation when I was trying to get with him as I did review Commissioner Faden. So I believe Aoli is the chair of Human Resources. Is that correct, Saul?
Ms. Coleman, Ms. Bowers, and Ms. Batts are the other members.
And Commissioner Ansari is the chair, correct?
Correct.
Okay. So, Commissioner, I'm sorry, I'm blindsiding a little bit. This is relatively straightforward. I think agenda, it should be in your packet. If you'd like to convene, we could get started.
You're on mute, Aoli.
Yeah.
Can you hear me now?
Yes, sir.
Good. All right. Well, why don't we go ahead and call to order the Human Resources Committee meeting for MDHA. And I think the first item on the agenda is the approval of the December 10, 2019 meeting minutes. I did not have those in my packet, Jim, to review.
They were sent separately in a separate email.
Okay. Does anyone on the committee have the minutes? No.
I do. I'm Paulette Coleman. I do have the minutes, and I read.
Yeah, it's,
Main thing in the minutes was the employee education assistance program. I mean, it was very short meeting in 1 page or 3/4 page.
I agree. I mean, if it's satisfactory for the committee, the minutes are very brief. I could read them to you if that's okay, or Commissioner Coleman could. As she said, it was a short meeting. Commissioner Thaden called the meeting to order. The meeting occurred on December 16th, 2019. They recommended a correction of the minutes to remove Emily Thaden's name from the attendance, and we vote. This is from the previous year's minutes of October 30th, 2018. That her name was removed. They approved the minutes from the previous committee meeting. And then Pat introduced the Human Resources Office, reviewed the mission, role, functions of Human Resources, and gave an overview, and covered how the agency's Human Resource Office is made up, how many employees we have, with the benefits and total rewards offered to MDHA employees. And the only item of substance that was a vote was we established an employee tuition assistance program in this committee. And the tuition assistance program has been very successful for us, but the committee discussed proposal and voted and recommended it to the board, and the board later approved it. That was the only item of action, and there being no further business, the committee adjourned. I'm not sure what the rules are, Saul, but would that suffice for the committee to approve the minutes, given that they're very concise?
Yeah, I think that suffices. Please send out the meeting minutes one more time to all the commissioners, if you would, LaTanya, and then maybe we'll re-ratify them at the next Human Resources Committee if we could just make a note of that. But for now, I think that suffices.
And should we move forward and vote on approving these?
Yes, you may.
All right, is there a motion to approve and just real quick, Jim, you said the 16th on the agenda said the meeting occurred on the 10th. Was it the meeting minutes from the 10th or the 16th?
I'm sorry, the minutes are dated and were written up on December 16th. The meeting in the committee occurred on December 10th.
Got it. Yep. Okay. Yep. So is there a motion to approve the meeting minutes from December 10th, 2019?
I move the approval of the minutes.
There's a second?
Second.
Any further discussion? All in favor?
Aye.
Those not in favor? It is approved. Second matter on today's agenda is around our safety and health plan resolution that was included in everyone's in the packet that went out today. Jim, so if Jim or Pat want to kind of give a brief summary of it, it would appear to be very straightforward.
Pat, could you cover this, please?
Yes, sir, I will. Thank you. The Safety and Health Plan is established to provide a safety and health program for the agency employees. It encourages safe and healthy work environments and makes certain that we promote and encourage a positive safety culture and to create guidelines to protect the employees from unsafe working conditions and injuries. This program actually was started back in 1972 when the state of Tennessee established the occupational health program for the entire state. During that time period, all employers, private and public, were encouraged to create an occupational safety program for their employees. And MDHA complied with the directives during that time period, and we have maintained the occupational health safety program throughout this time period. So the program is designed to make certain we have management commitment to the program and also give employees an opportunity to involve in making certain our workplace is safe for them and for our residents. We continuously analyze the work site to make certain we have controls in place to control hazards and any potential hazards in the workplace. We develop methods to prevent and control any existing hazards that might exist. It provides for training for the managers, the supervisors, the employees to understand what the safety standards are about and make certain they work every day to make certain they keep the workplace safe from hazards. It also requires us to provide safety equipment, personal protective equipment, and devices necessary to protect employees while working. And it also established administration for the safety programs at work to make certain we have processes for reporting, for investigating, and creating a complaint process that if an employee sees a condition or know about a condition that's not being addressed, they have an opportunity to complain about it both to the employer and to TOSHA. So the purpose of this, today's approval would be for us to update the organizational chart within the plan and also to indicate the current board's approval for the plan itself. So we are asking for your approval to update the agency plan to be provided to the state of Tennessee.
And this will go before the board in August. And Pat, we will need to provide the entire plan as part of our handout next time. I apologize to the board for missing. I was on vacation until this morning, so on FMLA. So we'll need to get the whole plan to the entire board.
I believe it was sent out to the entire board.
What?
I don't think the entire plan was, Pat.
Okay.
So maybe what we want to do this time then is just to make this informational, but with the understanding that it will be before the board at the next board meeting. And since the board doesn't have a copy of the plan in front of it, and in the meantime, Pat can send out the actual plan to all the board members and then be prepared to vote at the August board meeting. How's that sound?
Yeah, I think that sounds. I think there's a couple questions I had leading up to that. So I think from a process perspective that we will delay vote on this particular agenda item till the August meeting as a matter of process, but from a matter of kind of sort of further insight. Does our plan, do we have any requirement to comply with federal OSHA standards, or does the Tennessee standard incorporate all of the federal standards plus more? Or
plus more. We have to comply with all federal standards. 27 federal contracts is what we administer. So we have to meet all OSHA standards and TOSHA standards. Got it.
How do we check? How are we ensuring that compliance? Like, what is the process for ensuring compliance?
HR is a safety office, and they are the ones who do the spot checks and do compliance, as well as we have periodic, and Pat can talk to it, safety education programs, so that each of the directors and property managers and maintenance supervisors are responsible for the safety at their site and maintain the safety standards that are inherent in our plan. So, but the compliance review comes out of HR on a periodic basis.
So essentially, we self-certified that we're in compliance.
Correct.
Okay.
And that's pretty much how we do compliance in every other regard. All of our programs have a compliance person assigned within the agency. Whether it's rental assistance for vouchers, we self-certify. Whether housing self-certifies, we meet the standards. HUD doesn't send anyone out to check on most everything that we do. We self-certify them pretty much every other lane as well.
Okay.
This is Paulette. Go ahead, Ayola.
And I guess sorry, Paulette. The last question I would have is where's our information on workers' comp? Who gets hurt? Who's offered jobs? How long are they out? Do we find ways to bring people back in for light duty, et cetera? Like where are our performance stats that relate to, I guess primarily to our workman's comp program?
Pat has all that, and we report that. Pat, you have to help me here. I think it's quarterly to the feds. All of our any injury in the workplace, but Pat has all that data. So Pat, if you can take the detail on that one.
Okay. OSHA requires that we report all of our injuries to them once a year in January every year. And So we have the OSHA reporting that we have to submit through a 300 report, and each year in February, we have to post that information throughout the agency for all employees to see. So we do have to comply with OSHA guidelines to submit that report once a year to OSHA. It's an online reporting.
So Jim or Pat or whoever's the best person suited. So, our workman comp. Well, first of all, I guess the question, I'm used to the private sector workman's comp rule. Are we part of an insurance pool? Is that a state pool? Like, how does our workman's comp work? Workers' comp.
Our workers' comp is actually done through private insurance. It's negotiated every year. It's based on our incident rates for injuries. And so it goes to the National Incident Reporting Service for insurance for workers' comp. We get a rating, and then we put that rating out, and we put the insurance out for bid each year. And that's how our insurance is, workers' comp insurance is covered each year.
Got it. And what is our rating?
This past year, our rating was 1.1 based on our incident rate.
So if we could, can we get a sense at the next meeting, can we get a sense of kind of sort of where our rating is versus kind of sort of whatever the peer standards are in this space? Because I just can't tell based on our peer group whether that's high, low, or right in line.
Yes, sir. I will provide that.
Thank you.
I just follow up. TOSHA does inspect us every year. We get a TOSHA inspection once a year for all of our properties.
The question I have relates to these safety standards and policies. How are they translated to the workers on the front line?
We have an agency safety manual that we have created that covers all the requirements under OSHA. We have one for the maintenance staff and for the office staff. So that safety manual is distributed to all employees within the agency. It includes all the plan controls that OSHA requires us to have. So that safety manual is updated periodically so employees will know what the safety rules are.
And that manual, nothing else other than assuming the employee will read it and adhere to it?
They are required to. In addition to that, we have training each year for all employees, for the maintenance staff. We go over all the required training that OSHA requires to train employees on each year. So employees go through at least 8 hours of training each year on all the safety standards that's required under OSHA. The supervisors have individual training to understand what their responsibilities are. And so in turn, we educate throughout the year on the safety standards. In addition to the fact, whenever we have an employee that's involved in an accident, we have a safety management committee who review all of those accidents to look for reasons why the accident happened and look for ways to make sure we can prevent those changes so we can not have accidents in the workplace. So it's an education process to go on throughout the year.
I'm raising this question because I was asked to participate in a meeting with SEIU, and I spoke with Saul and I spoke with Jim, and then I learned from SEIU that somebody else from the commission had already, or some people from the commission had already met with them. So it was approved. And one of the things that, and I'm aware that I was just there to listen, and I provided Saul and Jim notes of the meeting because there were questions, and I said that I would get back to them with the issues. But one of the things that arose from the discussion was they feel that they work, at least the representatives who were at the meeting, and it was a Zoom meeting, feel that they represent in an unsafe and dangerous environment. And they also felt that there was not adequate training, and I didn't ask, well, what kind of training with what type of personnel. I just thought it was very, very interesting. And as I shared with Jim after the meeting, very often at the executive level, we can perceive that all I's are dotted and all T's crossed, but as the trickle down occurred, there are lots of breaks and things aren't happening exactly as we would like. So I was just very curious about that. And as I said, it could be just a misperception or whatever, but I don't think having a manual in place and a requirement with no kind of follow-up to ensure that the reading has taken place, or no kind of, I'm going to say training or whatever else has taken place, there's an opportunity for things not to happen. So this is just an FYI.
Well, thank you. And when we meet, we're happy to go over it with you. From the management standpoint and from my personal standpoint, I'm confident we have a safe environment for our employees. It's something I worry about a lot. I'm on these properties constantly. Will Biggs is. We have senior property managers. We have property managers. We have maintenance supervisors. All receive safety. Twice a year, I meet with all the employees. We break the team into half and do it half each time. And each time we do that, we talk about safety. I address it there. Each employee is required to sign that they've read the safety manual. In addition, they receive training I just touched on. It's more extensive than she got into. And the Tennessee State inspects us each year and grades us. So we spend a lot of time on it. Our accident rate is quite low. We do everything we can think of. And I think, it's a topic we discuss all the time. We've covered this with SEIU. I've covered it personally with the shop steward, and we've asked them for any of their suggestions on additional training. And to date, we look forward to them providing those. So, but we can discuss this in more detail when we meet.
All right. So from a process perspective, we are going to delay a board vote on an occupational safety and health plan until we receive the plan, have a chance to review it, and the goal is to do that at the meeting for August. And included in that, Pat, you make sure you're very specific to specify that we're going to update an organizational chart as part of this process. Make sure that org chart is provided.
Yes, it's in the plan. It's in the back of the plan.
Okay, thank you. All right, and for our last and final topic, or agenda item for today, Pat, it looks like there's just an informational update, no vote required, but you're just updating us on kind of sort of what's happening with SEIU negotiations. And I believe in the last meeting they had kind of focused on, is there an opportunity to try to achieve hazard pay or something like that for working inside of our portfolio during this COVID-19 moment in time for us here in America. So why don't you go ahead and give us an update?
Okay. SEIU has asked for hazard pay for essential workers, and basically they describe essential workers are those who have exposure to the public. And we took a look at their request, and we looked at the regulations and the guidelines for hazard pay under the CARES Act. And we also consulted with Metro government because they have implemented hazard pay for their employees. When we looked into the act, we discovered that the federal funding is being provided to local governments in response to the pandemic. And included in that would be hazard pay for first responders, such as policemen, firemen, EMTs, hospital workers, and water service workers whose job requires them to respond to people with the COVID virus or take a working environment to mitigate the spread of the COVID virus. And also, we looked at them to see if we could qualify under the program, and MDHA does not qualify for federal funding under the CARES Act. And based on the guidelines, MDHA employees do not qualify as first responders, and so in turn, we cannot qualify to give them hazard pay under those federal guidelines under the CARES Act. However, we have made considerable efforts to make certain we protect our employees when working with the public. We have provided PPE for all of our employees. We have provided training on the COVID Act, how the virus is spread. We have taught them how to use PPE correctly. And we have developed a protocol that if they have to respond to a work order or go into a public environment where they might be exposed to the virus, how to protect themselves to make certain that they do not get exposed. For example, making certain they maintain social distancing, making certain they have their mask on. And before they go into a resident apartment, we verify that no one in that apartment has reported that they are positive for it. But at the door, they can also ask the residents, do anyone have a fever? Does anyone have cough, cold, to determine if there is a reason not to go into that apartment where there might be someone with symptoms of the virus. So we have taken those efforts to protect them, but at this point, we cannot determine that we can qualify to give them hazard pay.
Communicated with them?
I'm sorry?
Yes, we met with Mr. Cole. I have to look the exact day. I think June 16th, and went through the entire what we just described to you. Both Pat and I met with him, went through all the rationale and explained it to him why we didn't qualify. For the commissioners, Mr. Nat Cole is our shop steward. He's a senior steward. He's the point of contact for negotiations. He's a shop steward, and Pat is our point of contact for him. But I sat in on it just to make sure that there was no chance that we left out a data point.
My meeting with them was after June 16th, and for reasons they said that it's negotiable as to whether or not they can get hazard pay. So whatever was said to them on June 16th has not really convinced them that hazard pay is not an option. And so I think we need to communicate that rather unequivocally or more clearly or way, because they don't understand that at all.
Okay, we'll do our best and reach back to them.
All right. So we are now at 10:26, and we have completed all the agenda items for the Human Resource Committee. So with that, is there a motion to adjourn today's meeting?
I move adjournment.
All right. Is there a second?
Second.
All right. Meeting adjourned. Thank you very much.
Thanks, everybody.
All right.
Thank you.
All right. See you guys on Tuesday.
Bye-bye.
Bye.